You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here. And today I want to talk to you about real estate investment trusts, or REITs for short. Now, we've all probably heard the argument, especially in Australia, that you cannot go wrong with property. And the Australian property market has been one of the little darlings when it comes to investment that has just, for a long time, returned very well to most property holders over the long term. Especially people who are willing to hold 7 to 10 years, most would see their portfolio of property double in that time, until about the end of 2010. Now, for anyone who was buying property around this time, 2010 onwards, the market has been very flat, very unpredictable, and it's been very hard to make a decent return unless you're doing developments or you're finding very high rental yielding areas, etc. So when we are investing in the share market, we can get access to the properties we wish to buy without having single property diversification, without being limited to only owning one property. We want to have diversification, so we can purchase a real estate investment trust which holds many different properties within their portfolio. They receive rental income back, and then they're able to actually write off a lot of the tax component of that income before paying it to you as a shareholder, because they draw down a certain portion of their income as depreciation by writing down the assets within the property, so writing off all the appliances and etc. You also, when you are owning property, you get any interest that you are paying on your loan. So if the real estate investment trust has mortgages attached to the properties, then they're actually able to claim that interest as a deduction from those rental repayments on the commercial and the residential properties that they own. This makes the tax component of a real estate investment trust extremely efficient, especially for us here in Australia, because there are a lot of great tax benefits for being a property owner, whether that property is positively or negatively geared. Now, if I, as an individual, wanted to purchase many properties, I'm going to need lots and lots of capital to outflow so that I can put deposits down on each of these properties. As the value of those properties increases, I can potentially do a cash out refinance to buy the next property, etc. And it's a slow process. However, the great thing about buying a real estate investment trust listed on the ASX or in any stock exchange is we are able to get a diverse portfolio of that property asset class. Now, this can contain short and long-term real estate, where we have long-term leases, short-term leases. We have a mix of commercial and residential property, and we also have potentially conglomerate sort of property areas where you hold a whole shopping center or a whole business district, etc. Now, today I want to talk to you about a real estate investment trust that I myself have purchased and own. Now, this is the Charter Hall Long Wale REIT, or ticker symbol CLW. Now, with this particular REIT, this is a real estate investment trust that holds 459 properties, and most of these are in the commercial space. Now, with these commercial properties that the Long Wale REIT holds, we have an average occupancy of 97.5%, meaning almost all of the properties have tenants in them paying an income and returning it back to the real estate investment trust and therefore the shareholders. The average length of the lease is 14.1 years at current state, which is just a brilliant amount of time to have tenants in your properties, and all of the rental increases are actually built into the leases. Therefore, if, let's say in that REIT, we hold a lot of petrol stations, okay? And these companies like BP or Shell, they lease that petrol station or the land that it's on. They're going to have built-in rent increases for keeping that business functioning from that. So after 2 years, that rent may go up indexed to inflation or even potentially more, depending on what is written into that contract. This means that the longer you hold the REIT, the more your income is going to grow, and therefore your dividend yield also grows. Okay, so if we were to buy in this particular REIT at say $4.50, and we were receiving, sort of 40 cents per year in dividends, that's going to be almost 10% that we are receiving back. I'm using a very, very simple example here, but I'm going to go into the more specifics very soon. Now, with our CLW REIT, this has a total portfolio evaluation of 4.5 billion, and this is held within the Charter Hall Group. The total Charter Hall Group actually holds $41.8 billion in assets. So you can see that their different portfolio REITs are actually very successful, and the whole company valuation keeps growing. However, this particular REIT, CLW, holds $4.5 billion in commercial assets. Now, to buy commercial property as an individual investor in Australia is a lot more difficult. You need a 30% deposit, and it's very hard to find tenants that you might be able to keep in there, especially as a lot of businesses are able to be more successful completely online. So this gives me a lot of confidence buying into a REIT which holds many commercial real estate properties, as opposed to trying to pick the right one myself if I wanted to go down that path in buying commercial property. So the current share price for CLW as of today is $4.92, okay? And this is actually smack bang in the middle of the 52-week high and the 52-week low, which was basically this time last year was the all-time lows, and we're getting back up to near the all-time highs around February last year. So we're sort of smack bang in the middle there. Now, the latest dividend will be paid out in May on the 20th, and this is actually 7.3 cents. We have a offsetted tax component on that share of 3.5 cents, which is completely tax-free due to the depreciation, claiming of interest, etc. on the properties, which means that our dividend is essentially 50% discounted on the tax rate we need to pay. Now, this is obviously a little more dependent on the amount of tax you earn, because obviously on the other remaining 3.8 cents per share that you own, that will be taxed at a rate that is in line with your income. So if you are paying 37 cents on the dollar, then you'll be paying that same 37% tax on the remaining component of your dividend. Now, why real estate investment trusts are so effective is because you're getting a lot of property diversification with just one trade, and it's allowing you to hold properties in many states. And even if you're buying on the United States Stock Exchange, for example, in the S&P 500, a real estate investment trust there is going to allow you to purchase shares in many, many, many states, as opposed to just being focused in one. I here in Australia have a real estate investment trust which allows me to own a broad portfolio of properties all over Australia, and that puts me in a really safe position, because if one state has an absolute bull run while another state crashes, I'm not going to have all my eggs in one basket and feel that pressure like I do with my current residential properties that I own as an individual, okay? So by buying these commercial properties through an investment vehicle called a REIT, I'm actually able to broadly diversify with a single trade into that property sector. And now that I'm a little more educated and would like to buy property through my share portfolio, I think this is how I'll get my property exposure in the future. Because being leveraged in order to get a mortgage and then purchase properties that way, there's a lot more active management behind it. You have to find tenants, find the right property manager, negotiate your fees. You have to make sure that you're trying to increase those rents as the cost of living increases and inflation occurs, while still paying down that loan and covering any repairs, expenses, making sure you're paying the mortgage, paying the rates, etc. So there's a lot more active management when you own a single property, and a lot more risk. So it makes a lot of sense to purchase a real estate investment trust listed on a stock exchange, where you make your purchase, you can simply set up your dividend reinvestment plans, and then walk away and relax. Now, what I like about this is when the dividend reinvestment plan is set up, basically my income is going to start reinvesting in itself, and my portfolio grows with that. You can check out my previous video on dividend reinvestment plans and why I love them. And basically, when this dividend reinvestment plan is active, my portfolio exposure grows every single quarter, because every 3 months I receive a new dividend which reinvests in itself, which buys me more shares. So the next quarter I get more dividends, which buys me more shares, and then I get more shares, which pays more dividends, which buys more shares, and so on. So this is the compound effect. And over a long period of time, my portfolio keeps growing. Whereas when you own an individual property, you're simply paying down a liability and hoping that the value of that property goes up. If you're not having any capital appreciation on this property, okay, and you're just simply paying down that loan, all you're really doing is reducing your liability. You're not making a capital gain here, but we still have to pay taxes on the rental income, etc. So I think real estate investment trusts are a super effective way to get exposure into the real estate sector, into property here in Australia and anywhere in the world. I would say it's a little less risky than buying an individual property, just because you have diversification across multiple properties and you're not just focused on a single one. And it's a little less actively managed, because you don't have to worry about whether you're getting tenants in. You don't have to call your property manager and discuss how we're going to pay for this hot water repair. You don't have to worry about getting plumbers out. It's all done in the background, and you simply wake up and receive a dividend every 3 months. And that is the best way to invest, in my opinion, and how I plan to continue my investment journey towards FIRE. So guys, if you want to get some property exposure, but you don't just want to go out and straight away buy a house, you can do this through a real estate investment trust or a REIT. I'm not saying you should buy the one I have bought, but definitely do due diligence before you go ahead and purchase a property. Perhaps you want some property exposure and you're buying a property as an individual for the wrong reasons because of that. By buying a real estate investment trust on the ASX, you're essentially ticking that box while still managing to do it in a safer way. And you're probably going to sleep better at night without having that mortgage attached to it. And when you finally find the right house for you, then you could look at getting a pre-approval for a loan and perhaps going down that path and purchasing it. But this may stop you rushing into purchasing property when you see that property is going up in the next 2 years post COVID shutdowns, and that's going to allow you to still get that exposure and potentially capture some of that growth in the market. Now guys, I hope you got some value out of this video. I hope you learned a little bit about real estate investment trusts, and particularly CLW of the Charter Hall Group. If you got any value from this, please like, share and subscribe, and I really look forward to seeing you in the next video.